Guys, the last month, with the power of AI, I have tested more than 1,000 different trading strategies in order to find this strategy, which is going to be producing the best possible results for me with the least possible efforts. And in this video, I will share with you all the findings which I found during the last month of research, and I will tell you the blunt truth nobody's going to be talking about. Because most of the people, when you're going online, they're going to be telling to you that AI or Claude Code is making you money while you're sleeping. And this is going to be the different video. This is going to be the video which is going to be showing you the real numbers based on the data of research. And trust me, I've put a lot of efforts into that. I'm going to show you the numbers. So in the last month, I have run more than 1,000 different back tests. And this is actually not even a close number because I was running a lot of back tests locally as well. So this number, I think it's closer to 1,500 at least. And I've analyzed different research lines among the different financial instruments. I've run among 40 different actually instruments and 9 different asset classes. And I've analyzed, that's all the instruments which I've analyzed. I've analyzed US stocks, indexes, futures, Bitcoin strategies, uh, crypto, metals, energy, rates, grains, volatility, options, institutional futures, global ETFs, sector ETFs, and credits. All those financial instruments I vigorously tested with different variations of parameters. And that's some of the strategies I've tested. Momentum and trend, mean reversal, seasonal, event-driven, volatility, carry, options income, options convexity, pairs, factors, crisis alpha, index calendar effects, and many, many, many more. And I've analyzed an enormous, all those strategies with enormous different parameters. I was never giving up and I was always telling AI to push it forward. And for example, for hypergrowth breakout, we've analyzed this more than 60 different variations. So exactly the same strategy was tested when the breakout happened, when the pull is happening, when I was taking money, when I was losing money, and I was analyzing and analyzing. Actually, AI was helping me a lot because AI was throwing ideas, AI was running the backtest, and AI was reading reports. And right now, when AI is running all those tests, I do not even understand it anymore. It got so smart, so it's hard to follow up with that. So when it comes to the bull transitions, I've analyzed this 40 different tests. Phase 6 momentum, 29 variations. Bitcoin's futures, 30 plus variations. Mean reversion futures, 18 variations. Seasonal, 14 variations. And so on and so forth. So you see, I was never giving up and I was analyzing vigorously different variations. And I found some great strategies, I'm not gonna lie. Some of them, they were producing very good results, and but it is important to mention that the results were during the past, and during the past were the last 3 years, 4 years were an enormous bull run when all this technologies market were driving up during the growth of AI, and it was provoking a very great results, which highly unlikely are going to be repeated in the future unless in a nearby future, unless there are going to be something crazy happening, which I do not believe. Maybe robotics is going to be changing the world, maybe something else. But once again, those results were produced during the very good bull run. And as you see, for example, equity momentum strategy produced during those times 84% returns with a max drawdown at 23%, which is like 1.5 Sharpe ratio. It is a great strategy to trade. However, like only if this year would be as productive, as good for technology growth as the last year. But right now is already June, the middle of the year, and I'm not seeing any growth as I saw in the past years. So I don't think that's going to be happening. Then seasonal futures calendar strategy produced 28% returns with a max drawdown of 22%, Sharpe ratio slightly below 1. Low volatility defensive equity 5.6%. Future strategy, it's Orbi and Bitcoin trends around 11%, 22% drawdown. Trend crisis strategy 7% return, 60% drawdown. And that's these strategies, the best ones I could find. And once again, I've tried all the different variation and different strategies, and most of them were losing because of the fees. The things which is nobody's talking to you about, they're going to be taking a huge amount of your profits. Imagine when you cannot trade a lot of instruments because the fees are going to be not there. And when everybody going to be saying you need to create a strategy which is going to be in and out, in and out, in and out very quickly, for example, on a 5 minutes chart, 15 minutes chart, and so on and so forth, then the fees are going to be eating you alive. And very few people they keeping them in mind, but they're going to be killing you, and the strategy is going to be not viable at all. So therefore, your strategy must be producing good returns regardless of the fees. And fees were actually calculated in my all back tests. The only thing which was not calculated is the slippage. So like minus 10% returns I would encounter for slippage at least. But in general, I think my results were more or less accurate because I was keeping in mind pretty much all the parameters which I learned over the last 3 years of investing. Anyway, long story short, after doing all this tremendous analysis, I realized that not a single strategy in the universe will produce you good results. And good and reliable results during the long period of time. Let's put it this way. There are strategies which are doing great, and there are ways you can leverage those strategies using margins. There are ways, but the problem with this approach is the more margin you're going to be adding, the more drawdown you're going to be adding as well, and therefore you're going to be increasing your risks. It depends what's you're going to be objective of your investment, but if your objective would be to throw the money, risks as much as you can, and hope it's going to be producing your good returns, then go for it. You can trade Bitcoin with enormous amount of leverage and hope that's going to be producing a good returns. And once again, I already found an edge on the Bitcoin when it's above a 200 simple moving average, which is when it's during the bull market. It produces good returns. You just need to leverage it up, and you can get, let's say, at least 30% returns from the market, no problem. And however, margin usually adds a lot of drawdowns to your portfolio. And considering that you do not want to draw your portfolio down more than 15%, you don't want to draw down at all. You don't want to have you seen your equity curve goes up and then drops down to close to zero. You want your portfolio to grow up steadily. And that's entire objective of my research was how could I make that happen? And after doing all the research I've conducted, I realized that the simplest possible way to make that happen is to combine multiple uncorrelated strategy into one solid portfolio. And important factor that they must be uncorrelated with each other. And if those strategies are combined in the right way, in the right balance, and they're not correlated to each other, then they're actually going to be adding value to each other. And they're going to be causing the actual, for example, here is the real effect of this combination. For example, the as you see here, the max drawdown is 2020, let's say around 18% is going to be average drawdown. And it's like if this is of average return of the single strategy. However, if you combine all the strategies together in one single portfolio, then the max drawdown is average drawdown is 6.5%. And this is the true finding which I discovered after doing all the research. That the true power is actually not in finding the perfect strategy which is going to be producing you good returns, because if that was the case, equity momentum would definitely be the winner. It has 84% returns and 23% drawdown. That would be the winner. But this kind of drawdown is not acceptable. Plus, these returns, they're highly unlikely they're going to be repeated, because that market, the one which was in the last years, it's highly unlikely is going to be repeated in any time soon. So, long story short, after doing all these findings and writing an enormous amount of lines of code, I believe the true power of for you is to have a combination of strategies. And if the combination of strategies, if by combining strategies the right way, you can use AI actually to do that. If they get AI is going to be understanding which strategies are correlated to which one and how to combine them properly. So for example, here it says here is a correlation matrix of all my strategies. As you see, the only correlation here is actually between phase 6 and trend strategy 123. And all the other strategies, they're more or less not really correlated here. And that's how you build in your portfolio so that your actual drawdown is lowered. And you need to lower it because even if you're going to invest in the index fund is going to be dropping 34% in the bear year. And you don't want that to happen with your portfolio. You don't want your portfolio to drop 50% during the bear market. You don't want that. You want, even in a bear market, earn money from the financial market. So that was my finding. That is everything I wanted to share with you. And I'm gonna open this cool community for the people who wants to use AI, and for those people who wants to use AI and in their trading, who wants to know how to build the strategies and how to use AI in order to build stable, reliable investment portfolio, which is going to be growing over time, regardless of all the market conditions. I'm going to drop the link in the description section down below. If that's going to be something which is going to be of your interest, feel free to check it out. And thank you very much for watching this video. And I'm looking forward to seeing you in the next one. Take care. Bye.